What are some of the best tools to manage your money? Should you ditch cable for an old-fashioned antenna? And how do you decide how much to invest in stocks, bonds, real estate, precious metals, and other investments? We'll answer these questions and more on this, the 94th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. So I got a packed show for you today. Got a couple of emails that I want to read to you that I got from some folks. Actually, I got a ton of email that I've responded to, but that I want to read some of these on the show. In some cases, responses to folks' email that I receive will be an entire show. Sometimes it'll just be sort of some quick responses on the show. But have been getting some great email from folks, people sending me links to articles that have been fantastic to read, and some tools. So I'm going to talk about a couple of those today. And then we're going to eventually get to the main topic of the show, which what I thought I'd do today, we'll talk about a little bit more in a minute, but I'm going to walk through some of the tools that I use to manage our money day to day. So that's what we're going to cover today. The first thing I wanted to mention, though, before we get to the main topic, I'm reading a book called The Bond Book. Simple enough. It is a phenomenal book about investing in bonds. And, for some of you, that might not be the most exciting topic to read about when you're at the beach this summer. I love this kind of stuff. If you ever want to understand bonds, The Bond Book is the book to get. It is a very easy read, but it's also very thorough. It's written by, and I'm sure I'm going to mispronounce her name, Annette, I'm going to say Thau, Thau. I'm sure I've butchered that name. I'm actually reading the 2001 version, which is the second edition. I believe she came out with a third edition, I want to say in 2010, which is actually going to be a very significant update given what interest rates have done since 2001. And in fact, the reason I have the 2001 edition is because I bought it before, I bought this years ago before she came out with the third edition, and I just hadn't read it. It's one of those books I bought and I put it on my shelf. And I'm reading it now. It's phenomenal. I'll probably go out. In fact, I will go out and find the 2010 edition, the third edition. Maybe I'll just check it out from the library if they have it. But this is a phenomenal book. And wanted to mention a couple of things in it. I mean, I'm not finished with it yet. But in the book, she does a couple of things that I found very interesting. The first is, she talks about interest rates. And, interest rates, in her view, are the single most significant risk, if you will, in investing in bonds. Far more significant than credit quality. That is the risk of default. Certainly that's a risk if you're investing, say, in emerging market debt or junk bonds and that sort of thing. But if you're in the investment grade credit quality type bonds, her view is the interest rates are the biggest risk to a bond portfolio. And for what it's worth, I agree completely with her. But she had a history of interest rates, and she was tracking the 30-year bond, the long bond, and she went all the way back to 1930. Now, the 30-year bond wasn't really in vogue in the 30s. I don't actually know when it was first sold by the U.S. government, but it became more of a significant part of how they financed their debt in the 70s. So before that, she used the longest terms available, which were 10 plus years. And she tracks those interest rates. And the interest, it's kind of scary in a way. When you look at this chart, which is on page 45 of her second edition, Exhibit 3-4, it shows interest rates. And they're low to begin with. In 1930, they're maybe around 3%. They dipped to around 2% by 1940. They more or less stay there between 2 and 3% for 15 years. And then they began the slow and steady climb upward until you hit the early 80s when they topped out, I want to say it was October of 81. I may have that date wrong, but early 80s, they topped out at just over 15%. Can you imagine investing in a 30-year bond, U.S. Treasury, and earning 15%, boy, I'd be there, right? Except that at the time they were selling at 15%, inflation was so high that your after inflation returns were actually negative. I mean, it was just a brutal, brutal time. I actually remember it quite vividly. I was in high school, and inflation was terrible, unemployment was awful, and the interest rates were through the roof. But the thing that caught me about this chart is we're kind of right now back to the time where we were in the 40s and 50s at these really, really low rates. I think the rate on the 30-year today is, I think it's about 3.25%, so pretty low by historical standards. And that's why people have been saying that there's only one place for rates to go, and that's up. We just don't know exactly when they're going to go up. We don't know how quickly they're going to go up. But I think everyone agrees they're going to go up. And they could go up significantly. And then the question becomes for you and I, well, what do we do about that, if anything? Maybe we don't do anything. But how do we protect ourselves for the eventual rise in rates? And I think part of that depends on your specific financial situation. If you've got a lot of debt, if I had a lot of debt, or if I had a variable mortgage, for example, I would want to be trying to lock those debts into the lowest fixed rates I could. That's what I would do. Again, I thought rates were going to go up several years ago, so I don't pretend to be able to predict the timing of this. But I do believe that rates are going to go up, and they're going to go up significantly over some period of time. And I would be very uneasy with long-term debt at a variable rate, particularly on something as important as my home. And if I had other debt, I'd try to lock it in at lower interest rates. By the way, the same is true if you have home equity line of credit, which are variable rates typically. And so that would concern me if I had a lot of debt on a home equity line of credit. And of course, from an investment perspective, what I've done, I don't know that, I'm not convinced this is the best approach, but it's the best one that I can figure out. For my bond portfolio, I stick with short and intermediate term bonds. So I don't have my bond portfolio, which is comprised almost exclusively of with mutual funds. I have some U.S. government issued bonds that I bought through Treasury Direct, but virtually everything I have is in mutual funds, and they're all short and intermediate term, meaning their duration is not more, their maturity is not more than, say, 5-6 years tops. The longer the maturity, the more that interest rates will affect the value of the bond. The other thing that caught my eye in the bond book, which isn't actually directly related to bonds, it certainly has broader applications. We've talked about it a lot. And that is the power of compounding. She has a chart in here about buying, she assumed you buy a 30-year bond, $10,000 investment, and she assumed it earned a 7% coupon. In other words, a 7% interest rate. Boy, wouldn't that be nice? Anyway, she walks through how much you would earn in interest directly from the bond, right? That's easy enough to figure out. 7% times 10,000 is $700 a year. It's paid semi-annually, so you get two payments of $350 a month. And if you add that up for 30 years, it's $21,000. That's pretty simple. But then she went on to say, well, what about your interest on your interest? If you took those interest payments and reinvested them in additional 7% coupon or 7% interest rate bonds, what would that generate? And of course, if you kept doing that and kept compounding the interest and reinvesting the interest again and again for the 30-year period, well, while your coupon interest off that initial bond, that is the 7%, again, would be $21,000 over 30 years, the interest on the interest, $47,780.91. Boy, that compounding is important. That reinvesting adds up big time, not in the short term, but in the long term, it is huge and will far outpace the dollars you actually invest and the direct interest or dividends or capital appreciation on that investment. The compounding just takes over after a while. I've seen it in our own investments. It's just a snowball effect, except, you talk about the debt snowball. Well, that can help you get out of debt. But in terms of investing, I don't know what, maybe I come up with a new name for it, the investing snowball. I'm not sure, that doesn't sound very great. But man, it picks up speed, and before you know it, you're earning far more off your investments than you're making in your day job. So I thought I'd mention that. I'm not done with the bond book, and I'm going to have some shows on bonds when I'm done with it. But an excellent book that I got from Amazon some time ago. By the way, if you have any interest in supporting this show, one thing you could do if you're ever going to shop on Amazon is go through my link on my site. It's easy to do. It's DoughRoller.net/AmazonDR, as in DoughRoller. DoughRoller.net/AmazonDR. That will redirect you to the Amazon page through my affiliate link. That would be one way you could support the show if you want to. And by the way, if you're thinking, well, gee, you must be making a fortune at Amazon, huh? No, not really. I checked my stats. So far this month, and we're almost to the end, I've made $12. So not big money, but hey, if you want to support the show, that's one way you can do it. Okay, the tool of the day, I read on the Wall Street Journal, tvfool.com. Love the name, tvfool.com. Here's what it does. If you're considering maybe ditching your cable box and cable altogether in exchange for an antenna, you can type in your address at tvfool.com, and it will tell you how strong the signals are at your home, and it will even tell you what kind of antenna you need to capture those signals. Is an indoor antenna fine? Do you need an attic antenna, or do you need an outdoor antenna? And it's something that we're looking at, and I thought I'd pass it on to you. I tried out the tool, and I haven't tested the accuracy of the information, but it was pretty easy to use and to follow. tvfool.com. You can get high-def signals over air from the main broadcast station, so it's something that we are looking at, and I thought I'd pass that on to you today. tvfool.com. Love that name. Okay, a couple of emails, and then we're going to get to the main topic. I've been emailing back and forth with Cedric. He's been a big help. He's sent me some articles and other things, and we've had a number of exchanges. And here's something that he wrote recently. And the first part of it may not make a lot of sense to you, but you'll get the gist of it when I get to the end of the email. He says, I understand your apples versus airplane analogy on the differences between stocks versus rental property. Investors are always presented with apples versus airplanes investment opportunities from equities, loans, annuities, insurance products, real estate, commodities, etc. All of these investment options are significantly different, but all of them are investment opportunities. You are personally invested in both. How did you decide how much to invest in equities versus how much to invest in real estate? Well, that's a great question. And I wish I could tell you that I had some magic formula, and I really gave this a lot of thought, and I had a big fancy spreadsheet. I didn't. So let me break it down into kind of two things. The first is, as it relates to REITs, right, which you invest through typically a mutual fund or an ETF, which I don't think is what he's referring to. He's referring to my actual real estate that I own and manage with my business partner. But in terms of REITs, that's just part of my asset allocation. So I have 10% in REITs, half of it in U.S. REITs, half of it in foreign REITs. And I've been very happy with that asset allocation and that performance. And that was just, I view REITs, although they have some bond-like similarities in some ways, I view them more closer to stocks than bonds. So my overall asset allocation at the moment, it's moving from 80% stocks, 20% bonds. It's moving from that. I'm moving it to 75% stocks, 25% bonds, in part just due to my age. My wife and I, you get a little closer to retirement every year, and so I'm making that adjustment. As far as the REITs go, I put those in the stock allocation in my mind, so they're part of that 75%. And I picked 10%. I generally don't have any allocation to an asset of less than 5%, because it just doesn't move the needle enough. It doesn't have the kind of effect that you want from a diversified portfolio. For me, there's no point in having, say, 2% in REITs. It's just, why bother? So 5% is sort of my minimum. That's what I have for a commodities fund, 5%, which frankly I'm not even sure I want or need. I'm actually revisiting that right now. But with REITs, it's 10%. Now, I think his question, though, kind of dealt more with my actual real estate investment. My friend and I, as I've mentioned in the past, have some properties we bought through HUD foreclosures. We had 5. We've sold 1. We have 4. So how did I decide on that number, and as compared to what I invest in the stock market or the bond market or precious metals? I do have some silver and gold, very, very, very little. But with real estate, frankly, it's such a different kind of investment. The amount of for me, it was as much a factor of time and opportunity as it was some higher level plan that I want X dollars of my investments in actual physical real estate. It takes a lot of work. It takes a lot of work to find the properties, to go visit them, to evaluate them, to figure out what you think rehab costs are going to be, then to manage that project, and then to manage the rental process. Now, in my case, all the properties are where I grew up in Ohio, so in some ways I've got it great, because my friend from high school, my business partner, poor guy, has to do all the work. And but that's also limited us because we could only go so far in that kind of arrangement. It's just not fair to him. And then he was busy at his job, and I got busy. The truth is, I wish, and he and I have talked about this, we would have bought more properties in the '08 to 2010, even 2011 time period, because the deals were just phenomenal. But what limited us was more really time than it was some decision about how much I wanted to allocate. So I don't know if that's probably not a very satisfactory answer. The reality is there is no one right answer to this. I mean, I know folks that have all of their money in real estate. They don't own any stocks, not one, no mutual funds. Their IRAs are self-directed, and they own real estate with their IRAs, which you can do. Wouldn't be my approach. I kind of like a more balanced approach, but again, for me, it was more a question of time. I would buy more real estate if the opportunity were there. And my friend and I have talked about it. I think the day will probably come when we buy more property, but that's not where we're spending our time right now. So really, it's a question of time for us more than it is some sort of asset allocation plan. By the way, in terms of precious metals, I alluded to those. If it were on a percentage basis, I probably have 0.0001% of our assets in precious metals. I don't believe that they're good investments. And in fact, I don't even really consider them investments as much as I do a hobby. And I'm sure there are people out there that are listening to this that disagree with what I just said. Please feel free to shoot me an email, dr@DoughRoller.net. Make the best case you can for precious metals, and I will be happy to read your views on that in a future show. But for me, I prefer investments that generate income, not investments that you basically, not investments of stuff that get dug up from the ground in Africa, shipped over here, and then stuck back in the ground for security. It's not my general approach to investing. Okay, one more email. This came from James, and he wrote in. He says, "Hey, thanks for the podcast and information on asset allocation. The material was a great review and contains information that will help in my portfolio rebalancing efforts. In researching this topic, I found the following link on the SEC, which is the Securities and Exchange Commission, the SEC website for a tool to help determine asset allocation that you may want to take a look at for your resource list." And I thought this was perfect since I'm going to be talking about my resource list or my tools list here in just a minute. And so the tool he's referring to, I'm going to read the URL. It's a bit of a long one, but here we go. It's ipers.org, ipers.org/calcs, CALCS, /assetallocator.html. And so there you go. And what you do is use just a few inputs, your age, your current assets, your savings per year, your tax rate, and it will generate a proposed allocation between stocks, bonds, and cash. And I found it to be an interesting tool. One of the things, of course, it can't take into account is your risk tolerance, right? And that's a very important consideration. There's no point in having an asset allocation plan if you can't stick to it, regardless of what the market is doing. So it can't take that into account. But I thought it was an interesting tool, one that takes you literally 25 seconds to input the data and hit the calculate button, and it will give you a proposed asset allocation. I think like any of these online tools, you always want to be thinking for yourself. But I thought it was interesting and something you might want to give a try out. I tried it, and it actually, for better or worse, hit my asset allocation right on the nose. It was perfect from what I had. I don't know. I'm not quite sure what that means. I guess I think like this calculator. I don't know, but I appreciate James you sending that in, and I wanted to share that with everybody. Okay, so now we're on to the main topic, which is kind of just a rundown of sort of the tools that I use or have used in the past to manage our money. And I have two goals for today's show. The first, of course, is just to let you know what tools I use. If you've listened to many of the podcasts in the past, you will have heard of many of these. Some I think will be new to you. But that's the first goal, just to share with you some of the tools that I use. The second goal, and I think frankly more important, is I would love to hear from you about the tools you use. So if they're not on the list that I'm going to run through, and you have other tools, whether they're calculators, free tools, paid tools, I don't care what they are, things that help you make the most of your money, please send in an email. And what I will do is add them to this list so everyone, we can just benefit from everyone's collective wisdom and experience. So that's really the goal. That's the second, and I think more important goal for today. And so I hope you'll send those emails in, once you've listened to the list, if you've used some great tools that I don't mention today. And so with that, I want to get started. And again, all of these tools will be listed in the show notes, so you'll be able to check them out. I'm going to run through them kind of quickly. I'll particularly run through quickly those that I've talked a lot about in the past. So we're going to start with investing tools, and I have several. The first one I've mentioned it in the past, Vanguard. I think as a mutual fund company goes, there's just nothing better. I've dealt with Vanguard extensively. I have a SEP IRA there, a rollover IRA, an inherited IRA. My wife has an IRA. Our son and daughter both have accounts there. I have taxable accounts there. I have a brokerage account there. And they just have the best, in my view, low-cost ETFs and mutual funds available. Now, again, they're not the only one. I have a Fidelity account. Fidelity's been great. So I'm sure you may use others, but for me, Vanguard is the best out there. Second one, of course, Betterment. I have a Betterment account. I'm actually going to be adding to the Betterment account. They're a sponsor of this show. They just make investing easy. I don't know if you haven't checked them out, even if you don't plan on using them, I think it's worth spending a little time on their website because they have some phenomenal tools to help you understand how different asset allocations between stocks and bonds affects your risk and your potential returns. So it's very sophisticated, yet also very easy to use. And so Betterment is the second one that I use and think very highly of. In terms of brokerages, my favorite broker is Scottrade. I actually don't have a Scottrade account anymore, or not one that's funded, and there's a story there, but I opened up my SEP IRA at Scottrade in 2010. And I did it for a couple of reasons. One is, the brokerage houses today, they're all inexpensive. Trades are all under $10. So unless you're a day trader or a swing trader where you're trading weekly, honestly, the cost of the trade is almost irrelevant to which broker you should use. The difference between $7 and $4 is meaningless if you only execute 3 trades a year. I mean, sure, all other things being equal, you go with the cheaper one, but all things aren't equal, and there are going to be other factors. Scottrade, I think, was $7 a trade or something like that, $7.95. I don't remember exactly, but it was very inexpensive. But the thing I liked about Scottrade is they have physical offices, so I could actually go in and talk to a real life person eye to eye. They had an office very close to where I work. They have an office very close to where I live, and so that's why I picked them, and they were great. I ended up moving the SEP IRA to Vanguard, as I've mentioned in the past, mainly to consolidate for the sake of my wife, so she doesn't have to. Again, if I get hit by a truck, she doesn't have to manage multiple accounts. But I was very happy with Scottrade, and they are linked here. I also use Options Express, by the way. They're not actually in my list. Maybe I should add them. I've been very happy with Options Express. They don't have physical locations, at least not that I'm aware of. But I did get a $100 bonus for signing up and executing a few trades. And I've been using them for the grow your dough throwdown. I think is what we call it. A bunch of goofy bloggers getting together trying to see who can outdo the other with $1,000 in capital over the course of a year. I update the status on that from now and again. I was in first place in that, by the way. I think I've dropped a second, but Options Express has been. I've been happy with it as well. But for me, Scottrade is just probably the one I would go to. For again, long-term investing. If you're a day trader, Scottrade's not. I would probably move something to like Thinkorswim, which was bought by E-Trade, for day traders or very, very active traders, options traders. But that's not my. I've been studying a lot about options. I've never bought or sold an option, and I think I probably will. Although I'll never be an active trader. I just don't see that. But for me, long-term investing, Scottrade was great. And then in terms of tracking my investments, I've mentioned before, Personal Capital is by far my favorite. It's not the only one out there. I know SigFig is another one. It's free as well. I've used it. Don't like it as much as Personal Capital. Personal Capital just provides a lot more detail. And so that's the one I use to track my investments, to track my asset allocation, to track my costs. I like it a lot. And then the other one that I think is phenomenal is Morningstar, both for research, but also to track your portfolio. The difference is it takes a lot of work to set up your portfolio and to manage your portfolio. And Morningstar, with Personal Capital, you just link your accounts and you're done. With Morningstar, you have to enter them by hand. It takes a lot of work to keep it updated. They have made it a little easier with some things, but it's still a lot of work. But the upside is the amount of information you get in their portfolio tracker and what I call portfolio monitor, which I've talked about in the past, is just phenomenal. And I think it is absolutely worth the effort. So I use both. I use Personal Capital sort of day to day to see how things are going, see what my asset allocation is, see what my expenses are. And then I use Morningstar for the sort of the deep dive when I really want to get in there and see exactly what's going on, exactly what my detailed returns are and all that sort of thing. And I love their Morningstar Portfolio Monitor, which, if you're not familiar with it, I talked about it in episode 86, DoughRoller.net/podcast 86. So you can check that out. So those are, at a high level, sort of the investing tools that I use. I also use an Excel spreadsheet, by the way. I track my asset allocation in a spreadsheet along with the value of my investments, and I update it every month. So I have that going back many years, and I can, it's kind of fun to see. Well, sometimes it's fun, sometimes it's sad, depends on how the market is doing. But you can see how your investments have performed over a long period of time. Of course, Morningstar and Personal Capital both do that as well. So I don't really need the spreadsheet, but I don't know, maybe old habits die hard. I still use it. So those are basically, at a high level, my investing tools that I use. And so what about budgeting and sort of managing your money? So my view of this is the fewer tools, the better. That's actually true for all of the different categories I'm going to talk about. The fewer tools you use, the better, because it's just less headache, less time spent dealing with the tools. So I actually only have a couple for budgeting and managing my money. The first, I've talked about it before, is YNAB. You Need a Budget. For me, absolutely the best budgeting software. I use it several times a month to track my spending, to know what expenses I have coming up, to know where my money is going. Very easy to use. You do have to do downloads from your various accounts, your checking account, your credit cards, and then upload them to YNAB. But extremely easy to do. And I just like the layout of it. It's really designed for budgeting and nothing else. Mint.com, which is free. YNAB is not free. They have a free trial. Mint.com is free, and if you use that, that's great. I've used it in the past. It kind of tries to do a little bit of everything, not just budgeting, but investments and other things. But for me, YNAB's budgeting tools are just superior. That's been my experience. The other thing I use is a high-interest savings account. Now, the one I use is Capital One 360. In the past, I've also had an account at Ally Bank. I've had an account at American Express Bank. These online banks simply provide the best interest rates. And so while I have a main account at Citi for my checking, I don't keep much savings at Citibank because they don't pay me any interest. It's just terrible. So I can move my money from my Citibank account to my Capital One 360 online, can make transfers with my phone, can deposit checks with my phone if I want. Very easy to use, and they pay great interest rates. Actually, Capital One 360 is generally not the highest interest rate, although it's pretty close. I think probably GE was GE Capital Retail Bank. It's now Synchrony, if I'm pronouncing it right, bank. Probably has the highest interest rates. And on that score, by the way, I do publish an update of the best interest rates every month. So one will be coming out here soon on the blog. And I track everything from checking accounts, savings accounts, mortgages, credit cards. And so you can check that out. I use Capital One 360. Again, Ally Bank is good. They're all good. They're all FDIC insured. All these online banks pay high interest, and that's where I keep my savings. The one thing I like about Capital One 360, I'll just add this, is they have what's called a money card. It's basically a debit card designed for teenagers. And our children, who are, one's no longer a teenager anymore, which is kind of sad. He just turned 20. Hard to believe. Anyway, both our children have the money card, and they can get the direct deposit for their paycheck right on the card. I can transfer money to the card, although I give them a hard time if I ever have to do that, and I quiz them as to why and what's going on with their money. But I can transfer money back and forth if need be, if they're ever out somewhere and they have an emergency and they need some money. So that money card has actually been great. One of the reasons I like Capital One 360. And there's no minimum balance. There are no fees with it. It's been really good. Our daughter uses it when she's at college. and so that's been great. The other thing I use is a credit card. It's part of our money management because there's a couple of reasons that I use it. We use credit cards basically for every purchase we can, whether it's at the grocery store, the gas station, a restaurant, whatever, or for bills. If we can pay, we pay our wireless, our cable bill with a credit card. We pay our cell phone bill with a credit card. Or the trash company with a credit card. Every service that will take a credit card, we use a credit card, and we do that for a couple of reasons. First is it's the safest way to spend money. There's fraud protection. If someone steals the card or whatever, I'm not going to be liable. So it's the safest way, as opposed to a debit card where if they take money out of my bank account, I may get it back, but it's gone until I do. It's a real pain. So I just think credit cards are the safest way to spend money. Second, it makes tracking my spending very easy as opposed to using cash. I just have to download my credit card transactions, upload them right into YNAB, and I know where every dime is gone. And the third reason is we get cash back on every purchase. So the card I like the best is the Barclays Arrival Plus World Elite MasterCard. It does take excellent credit to get. I will warn you of that if you're not, they don't really publish details, but if your credit score is not at least, and I've got to believe high 600s, probably more like in the 700s, it may be hard to get. But you earn 2 points for every dollar you spend, and then if you use that for travel, which we do, they're each worth a penny. So basically it's a 2% credit card. But then they also give you a 10% bonus, so it really comes out to 2.2. It's not the only card to use. I've used the Venture card. I like that a lot from Capital One. It's a 2% card as well. But Barclays card gives you that extra 10% bonus, so it comes out to 2.2. So why not use that? And that's about it. That's everything. We manage our money. We have, of course, we have a standard checking account at Citi. We have our high interest savings account at Capital One. We use YNAB to budget our money, and I put everything on a credit card. And it's as simple as that. I'll say as a final thing before we move to the next section, I do automate everything that I can. I guess you could view that as a tool. I don't actually list it on I won't list it in the show notes. But, we automate everything we can, just makes life easier. And that's all we need. That's what we do. Okay, credit and debt. Now, the good news for us is we don't have any debt other than our mortgage. So a lot of these tools I used to use, don't use them anymore because I don't need them. And if you're in debt and working to get out, someday you're going to be able to say the same thing. And by the way, if that's you get out of debt, send me an email. I'd love to hear about it. So what do I use? So the first thing to track our credit is annualcreditreport.com. That's where you go to get your free credit report. That I do check once or twice a year just to make sure there's no shenanigans going on in my credit history from fraudsters or whatever. But that's the first tool. It's free. You get a free copy of your report every year from each of the 3 major credit bureaus. So that's something to do. To keep track of your credit, your credit file. In terms of credit scores, there's really 3 options. One is MyFICO. They're sort of the folks behind the official FICO score. You can't get your score for free. It costs a little bit. They do give you a break the first month, and so you can get your official FICO score. I generally would do that if I were trying to buy a home and I really needed to know my official FICO score. I would probably use my FICO in that circumstance. Now, a couple other free options are Credit Karma and Credit Sesame. They give you what's called an educational score. I think it's a good score, but it's not using the FICO formula, so it's going to vary a bit from your actual FICO score. That's the downside. The upside is they're totally free. You don't even have to give them a credit card. And not only do they give you the score, which I've tested it, by the way, using at least my own credit file, and they were not much different from a FICO score. But they give you what's hurting your score, what's helping your score. It's a great way to improve your score. And as you do the things to improve the score, it absolutely will affect your FICO score as well. In terms of getting out of debt, there's a great debt reduction calculator. I've linked to it in the show notes. Again, you'll find the show notes at DoughRoller.net/podcast94. And it's just a debt reduction calculator using Excel. I have an article on the site about it. When you go to the show notes and you'll see the link, it'll take you to the article I've written. The article walks you through it a bit, and there's a link to it so that you can download it if you want. But basically, it allows you to put in all of your debt, the interest rates, the balance, the payments. You can customize the payments if you want to pay more on one debt or another. You can also indicate what order you want to pay the debts. You want to start with the smallest debt or the highest interest rate or whatever. and it calculates how long it'll take you to get out of the debt, what your payments will be, how much interest you'll pay. It's a very easy calculator to use, and I think gives you some great information. Now, there are other options, and I mentioned them here as well. One is called Unbury Me, Unbury, UNBURY .me, and a very good calculator, very easy to use. And again, it's a debt reduction calculator that will show you how long it will take you to get out of debt. When you go to it, it's a bit jarring because it's got this bright blue background. It comes up on your screen. You're like, what is that? But very easy to use, and I think you'll like it if you check that out. Unbury, UNBURY.me. That's another resource. Another resource for getting out of debt, one that I've talked about in the past, is called Ready for Zero, and it's a tool that can help you. It's a company. I've talked to the folks there. I've met them in the past, and you can sort of, I would describe it as the personal capital for debt, where you can link all your debts, come up with a plan. They will even, depending on what plan you use. There's free plans at Ready for Zero, then there are plans that cost a little bit of money, but they can help you with the whole process of figuring out what debts to pay off first, how it will affect the time it takes you to get out of debt, and how much it'll cost. Very, very easy to use, and so that's another great tool. And then the last thing I used was, I don't use them anymore, I don't need to, but were 0% credit cards. I mean, I use those to get out of debt. You've got to worry about or at least think about the balance transfer fee, usually 3%. But we moved our debt over to 0% cards for 15, 18 months at a time, then rolled it over to another one and paid off our debt for a lot less money and much quicker. So that was another tool that I used to use. We got out of our credit card debt, got out of our other debt, and so don't have to use it anymore. But if you're fighting to get out of debt, it's something to consider. I think the big thing there, and I've done a whole episode on balance transfers before, balance transfer credit cards. The big risk for me is actually, it's not the transfer fee. It's 3%, which is going to be much better than paying 15% interest on a credit card. The big risk is if you pay off one card with a 0% balance transfer credit card, do you then end up finding yourself going back to that old card that you've paid off and charging it back up again? Do you find yourself going into more debt? That, to me, is the biggest risk of using a 0% balance transfer card, and something where you just need to be honest with yourself and understand, will you really be able to toe the line and not go into more debt? So if you want more background on how to use them, what they are, the things to look for, you can check out podcast 44, DoughRoller.net/podcast44. And that's pretty much it for credit and debt. Those are the things that I use to get out of debt, and the things that help me, and hopefully they will help you as well. Okay, a couple more resources before we close out the podcast. The first relates to real estate, and I have a couple here that I like, just a few. So the first is Zillow. You've probably heard of it. They actually are just announced today that they're going to buy, I think it's for 3.5, it's not billion, is it? It's got to be 3.5 billion. I'm going to look it up on Google to make sure I get it right, but they're buying Trulia. That's got actually some real estate agents upset, because real estate agents spend a fortune advertising on sites like Zillow and Trulia. Yeah, $3.5 billion. Unbelievable. Can you imagine starting a website and selling it for $3.5 billion? Hey, if anyone out there is listening and wants to buy DoughRoller.net for $3.5 billion, dr@DoughRoller.net, shoot me an email. Anyway, so Zillow is acquiring Trulia, but these are both, I use Zillow, but they're great websites for researching real estate purchases, real estate values, and all that sort of thing. I'm sure if you've used it, you've been on there to check your own your own home and how much it's worth, or maybe your neighbor's home or your brother-in-law's home or whatever. Sometimes my wife and daughter and I, we've all got our iPads and we're just on Zillow talking about different homes and whatnot. So that's one tool that I use and like quite a lot. For HUD Homes, this is on the real estate investing side. This won't apply for everyone, but I have a link in the show notes to the website where you can research HUD Homes, and these are foreclosures. Actually, it can be a great way to find your own home that you're going to live in. This is not just for investing. In fact, if you're going to be what they call an owner-occupied, you're going to buy the home and live in it, you get a leg up on investors. You get to bid before the investors do. And that's where a lot of the best homes go quickly to folks that are going to actually live in them. So there's a link to that site in the show notes. My favorite mortgage calculator, I've talked about this in the past, Carl's Mortgage Calculator. I've actually talked and emailed to Carl. I years ago emailed Carl, said, "Hey, Carl, I love your mortgage calculator. You want to sell it?" He goes, "Nope." A year later, I said, "Hey, Carl, it's Rob again. Love your calculator. You want to sell it?" "Nope." I did that about 3 years in a row. And then I decided to leave Carl alone. He's a good guy. I think he's maybe a professor. I'm not sure, but he just built this calculator years ago, and I think it's one of the best. So I've linked to that in the show notes. And then in terms of mortgage rates, one of the things when you're either buying or refinancing a home is to try to get the best mortgage rates you can. I have a link in the show notes to the page on my site where we list a bunch of mortgage rates. It's updated throughout the day. That's one option. I actually used it the last time we refinanced our home and got a great rate. This was a couple of years ago. Ended up with what they call a super conforming loan, 30-year fixed at 3 7/8. A little bit lower than what you can get today, but rates are still pretty low. And so you can check out that page if you're looking to either refinance or buy a mortgage or perhaps buy a home. And that's basically it for real estate. And then lastly, I wanted to mention in the retirement category, two, calculators that I think are worth checking out. One is called the Retirement Nest Egg Calculator from Vanguard. It's a very simple calculator to use. And what it does is it basically, you just set three different data points. How many years you want your portfolio to last in retirement, your portfolio balance, and how much you spend each year. So this would be for someone either just getting ready to retire, maybe you're a few years out, you want to see if you're ready. And then the other thing they ask you is how much are you going to have invested in stocks, bonds, and cash. That's it. And then you hit a button that says Run Simulation. And it runs the simulation. And it tells you your odds of your portfolio surviving for 30 years. So just as an example, 30 years, let's say you got $1 million. Let's say you want $45,000 a year in income. And we'll put stocks at 60%, we'll put bonds at 30%, and we'll put cash at 10%. We'll run the simulation. And what it's doing is running what's called a Monte Carlo simulation. And it basically looks at all different past markets. And it says, well, we don't know what the market's going to be like going forward for 30 years. But what we'll do is we'll run 5,000 possible scenarios of what the market could do over the next 30 years. And for each one of those 5,000, we'll determine, will your portfolio last for 30 years or will you go broke? And then out of the 5,000, we'll add up all of the yeses your portfolio lasted, divide it by 5,000, and we'll give you a percentage odds that your portfolio will survive. And in this case, given the assumptions, 30 years, $1 million in retirement nest egg, $45,000 a year in spending, and the allocation that I mentioned, 87% chance of your portfolio surviving. Now, how could you change that? If you were in this situation, what could you do? Well, you could work a little longer. That's one option, right? You could decrease the amount that you're going to spend each year. If I drop this from 45 to 40 and run this simulation, the percentage goes from 87% to 93%. You could change your portfolio asset allocation, maybe make it a little heavier towards stocks, right? The potential downside to that, of course, is that you've got to be able to weather the storm. If I bump it up to 70% stocks, interesting, it actually goes down 2%, 91%. Now, if I take 10% out of cash, make that 2%, and let's see here. I'm going to play with this a little bit. 70% stocks, 28% bonds. Let's see what it does. Goes from 91% to 92%. Well, there you go. Well, anyway, a tool that I thought you might find interesting, one that you can play with a bit. You'll see a link to that in the show notes. And the last one is what's called the Flexible Retirement Plan. It's very easy to use. It does require a little more data. And basically so if you think of the first tool from Vanguard, that's if you're about ready to retire, right? This tool, the Flexible Retirement Planner, is more for those that are still saving up for retirement. So it asks you a bunch of stuff: your age, when you're going to retire, your life expectancy, what you think of inflation, your tax rates, how your portfolio, both your taxable portfolio, your tax deferred portfolio, your tax free portfolio, that would be Roths, right? And other information. And then it basically runs Monte Carlo simulations, much like the Vanguard tool, and shows you gives you a probability of success based on all these factors. And by the way, there's more data it takes in, like how much you're going to spend in retirement, for example. And it gives you a probability of success along with a nice graph that shows you how your investments are growing. Hopefully they're growing, right? And so that's another, it's free. So that's another one that I wanted to mention. And actually that kind of rounds out. I know I've kind of run through a lot very quickly. Now, I know there are all kinds of tools out there that could be added to this list. But I wanted to give you these. I think it gives you a good start. And hopefully you'll find them helpful. Again, you can check them out. You'll see links to everything if you go to the show notes, DoughRoller.net/podcast94. And again, as I mentioned before I started my list, what I'm really hoping for is that you all can send in other links to other tools and resources that you think could help folks, and I can add them to the list. That's my goal. I hope you'll help me out with that. If you have any great suggestions, send them to me, dr@DoughRoller.net. And that brings the podcast to a close. Hope you have a great day. And remember, until next time, the best thing money can buy is financial freedom.